The Ultimate Trading and Investing Bible. By Booksmat Club. Introduction: The Trader's Odyssey. The market is a mirror. It reflects not just prices and trends, but the psychology, discipline, and adaptability of those who dare to trade it. This book is not another collection of indicators or half-baked strategies. It is a complete blueprint for transforming yourself into a professional trader, capable of surviving and thriving in any market environment. Trading is one of the few pursuits where you can be right and still lose money, where discipline matters more than intelligence, and where the greatest enemy is not the market, but yourself. Most traders fail, not because they lack knowledge, but because they lack the right structure. They chase profits without understanding risk, analyze charts without mastering psychology, and burn out before they ever achieve consistency. This book is different. What this book will teach you. 1. The core mechanics of markets. How prices really move beyond simplistic technical analysis. 2. Professional grade strategies. Not just setups, but the institutional frameworks behind them. 3. Risk management as a weapon. How to protect capital so you can fight another day. 4th. The psychology of winning. Why most traders self-sabotage and how to break the cycle. 5. Systematic trading. Turning randomness into rules and rules into consistent profits. 6. The trader's lifestyle. How to sustain peak performance without burning out. Who is this book for? Beginners. Who want to skip the costly mistakes most traders make. Intermediate traders. Stuck in a cycle of inconsistent results. Advanced traders. Looking to refine their edge and adopt institutional techniques. Investors. Who want to trade smarter around their long-term positions. How to use this book. This is not a passive read. It's a training manual. Study one chapter at a time. Master each concept before moving forward. Apply the exercises. Trading is a skill, not just knowledge. Keep a trading journal. Your progress depends on honest self-assessment. Revisit sections as needed. The market will test different skills at different times. The path ahead. Trading is not a get-rich-quick scheme. It is a craft, one that rewards patience, discipline, and adaptability. Whether you aspire to trade full-time or simply want to sharpen your investing skills, this book will give you the tools to do it right. The journey begins now. Turn the page. Chapter 1. Trading and Market Basics. The stock market is a vast and complex financial ecosystem where buyers and sellers exchange ownership in companies through shares. To understand how it works, we must first break down the fundamental components that make the market function. At its core, the stock market consists of exchanges, centralized platforms where securities are traded. The most well-known exchanges include the New York Stock Exchange, NYSE, and the NASDAQ. These exchanges provide liquidity, ensuring that traders can buy and sell shares efficiently. When you place a trade, your order goes through a broker, an intermediary that connects you to the market. Brokers can be traditional full-service firms or modern discount online platforms like Robinhood or Interactive Brokers. The type of order you place matters significantly. A market order executes immediately at the current price, while a limit order only fills at your specified price or better. Stop-loss orders protect you from excessive losses by automatically selling if the price drops too far. Trading itself comes in many forms. Day trading involves opening and closing positions within the same day to capitalize on short-term price movements. Swing trading holds trades for days or weeks, capturing intermediate trends. Position trading is a longer-term approach, often lasting months or years, aligning more with traditional investing. Scalping is the most rapid form, where traders profit from tiny price fluctuations, sometimes holding positions for just seconds. Technical analysis is the study of price charts to predict future movements. Candlestick patterns, developed in 18th century Japan, remain one of the most powerful tools. Patterns like the doji, hammer, and engulfing can signal reversals or continuations. Support and resistance levels indicate where prices have historically struggled to move beyond, offering strategic entry and exit points. Trend lines help visualize the market's direction, while moving averages smooth out price data to identify trends. Risk management separates successful traders from those who blow up their accounts. The golden rule is never to risk more than 1 to 2% of your capital on a single trade. This means if you have a $10,000 account, your maximum loss per trade should be $100 to $200. Position sizing adjusts your trade volume based on stop-loss distance. Wider stops require smaller positions to maintain the same risk level. Diversification across uncorrelated assets further reduces risk. The market's irrationality often tests traders' patience. Prices can defy logic for extended periods, which is why discipline is crucial. Emotional decisions lead to overtrading, revenge trading after losses, or abandoning proven strategies during drawdowns. A well-defined trading plan with clear rules helps maintain consistency. Backtesting strategies on historical data ensures they work before risking real money. Understanding market participants provides an edge. Retail traders are individual investors, while institutional traders represent large firms like hedge funds. High-frequency trading (HFT) firms use algorithms to execute thousands of trades per second, profiting from tiny inefficiencies. Market makers provide liquidity by constantly quoting buy and sell prices, earning the bid-ask spread. Whales are ultra-wealthy traders whose large orders can move markets. Volume, the number of shares traded, confirms the strength of price movements. High volume during breakouts suggests genuine interest, while low volume may indicate false moves. Order flow analysis tracks buying and selling pressure in real time, revealing where big players are active. Time and sales data shows every transaction, helping spot accumulation or distribution. The bid-ask spread represents the difference between the highest price buyers are willing to pay and the lowest price sellers will accept. Narrow spreads indicate high liquidity, common in popular stocks like Apple or Tesla. Wide spreads appear in illiquid stocks, increasing trading costs. Slippage occurs when orders fill at worse prices than expected, common during volatile news events. Market phases include trends, upward or downward, and ranges, sideways movement. Trending markets favor trend-following strategies like moving average crossovers or breakout trades. Range-bound markets suit mean reversion strategies, buying near support and selling near resistance. Recognizing the current phase prevents using the wrong strategy at the wrong time. Economic cycles influence market behavior. Expansion phases see rising stock prices, low unemployment, and high consumer spending. Contractions bring recessions, falling markets, and economic slowdowns. Central banks adjust interest rates to control inflation and stimulate growth. Lower rates make borrowing cheaper, boosting stocks, while higher rates cool overheating economies. Global events cause market volatility. Earnings reports, Federal Reserve announcements, geopolitical conflicts, and natural disasters all move prices. Traders must stay informed but avoid overreacting to headlines. The VIX index measures expected volatility, often spiking during crises. Fear-driven sell-offs create buying opportunities for calm investors. Brokerage accounts come in different types. Cash accounts require full payment for trades, while margin accounts allow borrowing money to leverage positions. Retirement accounts like IRAs offer tax advantages but restrict trading activity. Choosing the right broker depends on fees, platform features, and asset availability. Trading psychology is the invisible force behind success or failure. Fear of missing out, FOMO, leads to chasing overextended moves. Fear of losing triggers premature exits from good trades. Greed causes overtrading or refusing to take profits. Acceptance of losses as part of the game is essential. Keeping a trading journal helps identify emotional patterns and improve decision-making. Technical indicators supplement price analysis. The Relative Strength Index, RSI, identifies overbought or oversold conditions. Moving average convergence divergence, MACD, shows trend momentum. Bollinger Bands measure volatility, with price often reverting to the middle band. No indicator is perfect. Combining several works best. Backtesting validates strategies before live trading. Historical data reveals how a strategy performed in different market conditions. Walk-forward testing splits data into segments, optimizing parameters on past data and testing on unseen data. This prevents curve fitting, where strategies work only on historical data but fail in real markets. Paper trading simulates real trading without financial risk. It helps practice execution, test strategies, and build confidence. However, the absence of real emotions can make results misleading. Transitioning to small live trades bridges the gap between simulation and full-scale trading. Market myths abound. "You need to predict the future to win" is false. Successful traders react to what the market gives them. More trades equal more profits ignores the value of patience. Complex strategies work better overlooks that simplicity often outperforms over-optimized systems. The journey to trading mastery is lifelong. Even professionals continuously learn and adapt. Markets evolve, and strategies that worked yesterday may fail tomorrow. Staying humble, managing risk, and sticking to a plan are the true keys to longevity in trading. Understanding market orders versus limit orders. Market orders execute immediately at the current best available price. They guarantee execution but not price, making them risky in fast-moving or illiquid markets. Limit orders, on the other hand, only execute at your specified price or better. They provide price control but may not fill if the market doesn't reach your level. Stop orders become market orders once triggered, useful for limiting losses or entering breakouts. Stop limit orders combine both, converting to a limit order after activation. The role of liquidity in trading. Liquidity refers to how easily an asset can be bought or sold without affecting its price. Highly liquid stocks like Amazon or Microsoft have tight bid-ask spreads and large order books. Illiquid stocks, often small caps or penny stocks, suffer from wide spreads and slippage. Liquidity matters most for short-term traders, while long-term investors can tolerate lower liquidity. Time frames and their importance. Charts display price action across different time frames: minutes, hours, days, or months. Scalpers use tick or 1-minute charts. Day traders favor 5-minute to 1-hour charts, and swing traders rely on 4-hour to daily charts. Higher time frames offer more reliable signals but fewer trading opportunities. Aligning your strategy with the appropriate time frame prevents mismatched expectations. Support and resistance, the foundation of technical analysis. Support is a price level where buying interest overwhelms selling pressure, halting declines. Resistance is where selling pressure stops rallies. These levels form due to collective market psychology. Traders remember where prices reversed before. The more times a level holds, the stronger it becomes. Broken resistance often turns into support, and vice versa. Trend analysis. Identifying market direction. An uptrend consists of higher highs and higher lows. A downtrend shows lower highs and lower lows. Drawing trend lines connects these swing points, clarifying the trend's slope. Moving averages, like the 50-day or 200-day, smooth price data, acting as dynamic support resistance. Trading with the trend increases success odds, as the trend is your friend until it ends. Volume, the fuel behind price moves. Volume confirms the strength of price movements. Rising prices on high volume suggest strong buying interest, while low-volume rallies may lack conviction. Volume spikes often precede reversals or breakouts. On-balance volume, OBV, tracks cumulative buying-selling pressure, signaling divergences before price turns. Candlestick patterns. Reading market sentiment. Candlesticks reveal the battle between buyers and sellers within a time frame. A long green candle signals strong buying. A long red candle shows intense selling. Doji candles with small bodies indicate indecision. Engulfing patterns signal potential reversals. A green candle engulfing a prior red one suggests bullish momentum. Risk-reward ratios, the math of trading. Every trade should have a predefined risk-reward ratio. A 1 to 3 ratio means risking $1 to make $3. This ensures that even with a 50% win rate, profits outweigh losses. Placing stop losses below support, for longs, or above resistance, for shorts, defines risk, while profit targets use measured moves or opposing levels. The impact of news and events. Earnings reports, economic data, GDP, unemployment, and Fed announcements cause volatility. Traders must decide whether to trade the news or avoid it. Pre-news positioning often leads to buy the rumor, sell the news reactions. Unexpected events, wars, pandemics, create gaps, prices jumping between closes and opens. Correlations between markets. Stocks, bonds, commodities, and currencies interrelate. Rising bond yields often hurt growth stocks. A weak dollar boosts commodities like gold and oil. Understanding these links helps anticipate spillover effects. The US dollar index, DXY, inversely correlates with emerging markets and commodities. Common trading mistakes to avoid. Overtrading. Taking low-quality setups due to boredom. Revenge trading. Trying to recover losses immediately. Ignoring stop losses. Letting losses run destroys accounts. Chasing performance. Abandoning strategies after short-term losses. Building a trading plan. A solid plan includes 1. Strategy. Entry, shock, exit rules, time frame, instruments. 2. Risk management. Max loss per trade, daily, weekly limits. 3. Journaling. Recording trades to analyze performance. 4th. Review. Process. Weekly, monthly evaluations to refine edges. The path forward. Mastering these basics lays the foundation for advanced strategies. Consistency, discipline, and continuous learning separate profitable traders from the rest. Chapter 2. Investing and Wealth Building. The world of investing is fundamentally different from trading. While traders seek to profit from short-term price fluctuations, investors build wealth over years and decades by owning assets that appreciate in value. The cornerstone of investing is the principle of compounding, earning returns on your returns, which over time can turn modest savings into substantial wealth. To harness this power, you must first understand the various investment vehicles available, their risk-reward profiles, and how to construct a portfolio aligned with your financial goals. The power of compounding. Compounding is often called the eighth wonder of the world, and for good reason. If you invest $10,000 at an annual return of 7% in 30 years, that investment will grow to over $76,000 without any additional contributions. The key is time. The longer your money remains invested, the more dramatic the compounding effect. Starting early is critical. A 25-year-old who invests $5,000 annually until retirement at 65 will accumulate far more than a 35-year-old who invests the same amount annually until the same age, even though the latter invests for only 10 fewer years. Stocks. Ownership in businesses. When you buy a stock, you own a small piece of a company. Stocks offer the highest historical returns of any major asset class, averaging about 10% annually over the long term. However, they also come with volatility. Short-term price swings can be dramatic. There are two primary ways to profit from stocks: capital appreciation, the stock price rising, and dividends, regular cash payments from the company's profits. Blue-chip stocks are shares in large, well-established companies with a history of stable earnings and dividends. Examples include Coca-Cola, Johnson & Johnson, and Procter & Gamble. Growth stocks, like many technology companies, reinvest profits into expansion rather than paying dividends, offering higher potential returns but also higher risk. Value stocks are undervalued relative to their fundamentals, often overlooked by the market but with strong potential for price correction. Bonds. Lending for income. Bonds are debt instruments where you lend money to an entity, a government or corporation, in exchange for periodic interest payments and the return of principal at maturity. They are generally less volatile than stocks and provide steady income, making them a key component of a balanced portfolio. Government bonds, such as U.S. Treasuries, are considered low risk since they're backed by the full faith and credit of the issuing government. Corporate bonds offer higher yields but come with credit risk, the chance the issuer may default. Municipal bonds, issued by local governments, often provide tax-free income. Bond prices move inversely to interest rates. When rates rise, existing bonds with lower yields become less attractive, causing their prices to fall. Mutual funds and ETFs. Diversification made easy. Mutual funds pool money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. They're managed by professionals but often come with higher fees. Exchange-traded funds, ETFs, are similar but trade like stocks on exchanges, offering lower fees and greater flexibility. Index funds are a type of mutual fund or ETF that tracks a specific market index, such as the S&P 500. They provide broad market exposure at minimal cost and have consistently outperformed the majority of actively managed funds over the long term. Sector ETFs focus on specific industries, e.g., technology, healthcare, while thematic ETFs target trends like clean energy or artificial intelligence. Real estate, tangible asset investing. Real estate investing can provide both income through rent and appreciation, property value increasing. Direct ownership of rental properties offers control but requires active management. Real estate investment trusts, REITs, allow you to invest in real estate without owning physical properties. They trade like stocks and must distribute at least 90% of taxable income as dividends. Commercial real estate, office buildings, retail spaces, typically offers higher returns than residential, but comes with greater complexity and risk. Real estate crowdfunding platforms have democratized access, allowing smaller investors to participate in large projects with relatively little capital. Alternative investments, beyond stocks and bonds. Commodities like gold, silver, and oil act as hedges against inflation and currency fluctuations. Cryptocurrencies, while highly speculative, have emerged as a new asset class with potential for outsized returns and losses. Collectibles, art, wine, rare coins, can appreciate but are illiquid and require expertise to evaluate. Portfolio construction, balancing risk and reward. Asset allocation, how you divide your investments among stocks, bonds, and other assets, is the primary determinant of portfolio performance. A common rule of thumb is to subtract your age from 100 to determine the percentage to allocate to stocks. E.g., a 30-year-old would hold 70% stocks. However, this should be adjusted based on risk tolerance and financial goals. Diversification reduces risk by spreading investments across uncorrelated assets. A well-diversified portfolio might include domestic and international stocks, bonds, real estate, and a small allocation to alternatives. Rebalancing, periodically adjusting holdings back to target allocations, ensures the portfolio doesn't become overly concentrated in a single asset class. Behavioral finance, the psychology of investing. Investors often fall prey to cognitive biases. Loss aversion leads to selling winners too early and holding losers too long. Herd mentality drives bubbles and crashes. Confirmation bias causes investors to seek information that supports their existing beliefs while ignoring contradictory evidence. Successful investing requires emotional discipline, sticking to a plan despite market noise. Tax efficiency, keeping more of your returns. Tax-advantaged accounts like 401ks and IRAs allow investments to grow tax-free or tax-deferred. Capital gains taxes apply to profits from selling investments held over a year, lower rates, versus short-term holdings, taxed as ordinary income. Tax loss harvesting, selling losing investments to offset gains, can reduce tax liability. Retirement planning, building financial independence. The FIRE movement emphasizes aggressive saving and investing to retire decades earlier than traditional timelines. The 4% rule suggests that withdrawing 4% annually from a retirement portfolio is sustainable over 30 years. Annuities provide guaranteed income but often come with high fees and complexity. The long game. Investing is a marathon, not a sprint. Market downturns are inevitable but temporary. Historically, every decline has been followed by a recovery and new highs. The most successful investors are those who stay the course, ignore short-term noise, and let compounding work its magic over time. Chapter 3. Advanced Trading Strategies. The transition from basic trading concepts to advanced strategies represents a quantum leap in a trader's journey. While beginners focus on simple buy and sell mechanics, sophisticated traders employ complex techniques that capitalize on market inefficiencies, volatility patterns, and multi-layered risk management. This chapter will dissect the most powerful advanced trading methodologies used by professional traders and institutional firms, providing you with the knowledge to elevate your trading to hedge fund levels. Options. Trading, the strategic advantage. Options represent financial derivatives that grant the right, but not obligation, to buy or sell an asset at a predetermined price before a specified expiration date. Unlike simple stock trading, options provide asymmetric risk-reward profiles where potential losses are limited while gains remain uncapped. The options market consists of two primary participants: writers, sellers, who collect premiums and assume obligation, and buyers who pay premiums for rights. Call options. Profit when the underlying asset rises above the strike price plus premium paid. Put options. Gain value when the underlying falls below the strike minus premium. The Greeks: delta, price sensitivity; gamma, delta's rate of change; theta, time decay; vega, volatility impact; and rho, interest rate effect, quantify an option's risk parameters. Advanced traders use spreads to limit risk. Vertical spreads. Combine long and short options at different strikes. Calendar spreads. Utilize different expiration dates. Iron condors. Profit from range-bound markets. Butterflies. Capitalize on precise price targets. Volatility trading through options deserves special attention. The VIX index measures S&P 500 volatility expectations. When actual volatility exceeds implied volatility, IV, selling options becomes profitable. Straddles, buying both calls and puts, profit from large moves regardless of direction when correctly anticipating volatility expansion. Futures and derivatives. Leveraged market access. Futures contracts obligate buyers and sellers to transact at predetermined future dates and prices. These standardized agreements trade on regulated exchanges, CME, ICE, and cover assets including stock indices, E-mini S&P 500, commodities, crude oil, gold, currencies, Euro FX, interest rates, 10-year Treasury notes. The futures market offers several strategic advantages. 1. High leverage. Through margin requirements as low as 3 to 12% of contract value. Second, around-the-clock liquidity on electronic platforms. Third, efficient hedging against portfolio risks. Fourth, arbitrage opportunities between cash and futures markets. Advanced traders employ futures for cash and carry arbitrage, exploiting price discrepancies. Basis trading, capitalizing on convergence of futures to spot prices. Calendar spreads, trading price differences between contract months. Intercommodity spreads, like crack spreads, oil refining margins. Algorithmic trading, the quant edge. Algorithmic trading uses computer programs to execute strategies with precision impossible for human traders. These systems analyze vast data sets, identify patterns, and execute trades in milliseconds. Key algorithmic approaches include market-making algorithms that continuously quote bid-ask prices, statistical arbitrage, exploiting temporary price divergences, momentum ignition, triggering and riding volatility waves, TWAP/VWAP strategies, slicing large orders to minimize market impact. Quantitative traders backtest strategies using 1. Historical tick data for accurate simulation. Second, walk-forward analysis to verify robustness. Third, Monte Carlo simulations, testing random market scenarios. Fourth, machine learning to adapt to changing market regimes. Execution algorithms like iceberg orders and dark pool routing help institutional traders move large positions without moving markets. Retail traders can access algo trading through platforms like MetaTrader, QuantConnect, or custom Python R solutions. High-frequency trading, HFT, the speed frontier. HFT firms exploit microscopic price differences and latency advantages to profit from latency arbitrage between geographically dispersed exchanges. Order book dynamics, like detecting large hidden orders. Liquidity rebates, earning payments for providing market depth. While retail traders cannot compete in pure HFT, understanding its mechanics helps avoid predatory practices like quote stuffing and spoofing. Cryptocurrency trading, digital asset strategies. Crypto markets operate 24/7 with extreme volatility, requiring specialized approaches. Arbitrage, between exchanges with price discrepancies. Yield farming, in decentralized finance. DeFi protocols. On-chain analysis, tracking whale wallet movements. Futures basis trading, exploiting premium discount to spot. Global macro trading, playing economic shifts. Macro traders analyze interest rates, GDP growth, and geopolitical events to trade. Currency carry trades, borrowing low-yield currencies to buy high-yield. Commodity curves, trading futures term structures. Sovereign debt spreads, between national bond yields. Behavioral edge, exploiting cognitive biases. Advanced traders profit from predictable irrationality. Overreaction trades. Fading extreme sentiment. Earnings season patterns. Playing post-announcement drifts. Index rebalancing flows. Front-running institutional adjustments. Risk management systems. Professional trading operations employ value at risk, VAR, models. Quantifying worst-case losses. Correlation matrices. Monitoring portfolio concentration. Circuit breakers, automatically halting trading during extreme moves. The institutional mindset. Transitioning to advanced trading requires, first, process discipline over outcome fixation. Second, continuous adaptation to regime changes. Third, technology stack optimization for execution edge. Fourth, multi-strategy diversification to smooth returns. Chapter 4, Trading Psychology and Mindset. The markets are not just a test of strategy, they are a relentless examination of your mental fortitude. While charts, indicators, and economic data provide the framework, it is your psychology that ultimately determines success or failure. The difference between consistent profitability and blown accounts lies not in the systems traders use, but in how they control their emotions, manage stress, and maintain discipline when real money is on the line. Chapter 4, the two brains of a trader. Every trader operates with two competing mental systems. The first is fast, instinctive, and emotional. It reacts immediately to price movements, fears losses, and chases wins. The second is slow, analytical, and deliberate. It assesses risk logically, follows rules, and makes decisions based on data rather than impulses. The battle between these two systems plays out in every trade. When markets move violently, the fast brain screams to exit prematurely or revenge trade after a loss. The slow brain, if properly trained, keeps you anchored to your strategy. Mastering trading psychology means strengthening the slow brain's control while recognizing when the fast brain is hijacking your decisions. Ors, the psychological pitfalls that destroy traders. Most trading failures stem from predictable mental traps. These are not just minor errors, but deep-rooted cognitive biases that distort judgment. 1. Overconfidence after wins, a streak of profitable trades. Tricks traders into thinking they're invincible, leading to oversized positions and ignored stop losses. 2. Loss aversion dash. The pain of losing $100 feels twice as intense as the pleasure of gaining $100, causing traders to hold losers too long and cut winners too soon. 3. Recency bias. Giving excessive weight to the last few trades or market events, distorting expectations for future performance. 4th, anchoring. Fixating on entry prices. I'll exit when I break even, rather than adapting to current market conditions. 5. FOMO, fear of missing out. Jumping into trades because others are profiting, even when the setup doesn't match your strategy. 6. Tilt trading. Emotional revenge trades after losses, trying to get back at the market. 7. Analysis. Paralysis. Overcomplicating strategies in search of perfection, leading to inaction or erratic decisions. Rewiring your brain for trading. Success. Neuroplasticity, the brain's ability to rewire itself, means you can train yourself to think like a professional trader. This requires deliberate mental conditioning, mental rehearsal. Before trading, visualize executing perfect trades, managing risk, and staying calm during drawdowns. Elite athletes use this technique, and traders should too. Emotionally intelligent journaling. Don't just log entries and exits. Record your mental state during each trade. Were you anxious, overconfident, or distracted? Over time, patterns emerge. Biofeedback training. Tools like heart rate variability, HRV, monitors help track stress levels in real time. Learning to stay physically calm improves decision-making under pressure. The 4 market moods and how to trade them. 6. Markets cycle through emotional states, each requiring a different psychological approach. Euphoric markets. When everyone is overly optimistic, e.g. during bubbles, the smart trader exercises extreme caution. This is when you trim positions, not chase highs. Complacent markets. Low volatility and steady trends encourage laziness. Traders must stay disciplined, avoiding sloppy risk management just because nothing bad is happening. Anxious markets. Uncertainty creates choppy price action. This is where counter-trend strategies shine, but emotional control is critical. Fear spreads quickly. Panicked markets. Capitulation phases where fear peaks. The best traders remain calm, looking for oversold opportunities while others sell at any price. The 5 levels of trading mastery. Traders evolve through distinct psychological stages. 1. Unconscious incompetence. Losing money without understanding why. 2. Conscious incompetence. Recognizing mistakes but struggling to fix them. 3. Conscious competence. Profitable when focused but requiring strict discipline. 4th. Unconscious competence. Trading intuitively but risk of complacency arises. 5. Meta-competence. Adapting seamlessly to changing markets while maintaining emotional control. Most traders fail between stages 2 and 3. Breaking through requires brutal self-honesty and a structured improvement process. Decision, fatigue, and how to beat it. Trading is a marathon of choices, and mental exhaustion leads to mistakes. Combat decision fatigue with predefined rules. Checklists for entries, exits, and position sizing remove guesswork. Strategic breaks. Step away after a set number of trades or hours to reset mentally. Energy management. Proper sleep, nutrition, and hydration directly impact trading performance. The hidden link between past trauma and trading errors. Unresolved psychological wounds, fear of failure, need for validation, or deep-seated risk aversion, often manifest in trading. A trader who grew up in financial insecurity might panic sell at minor losses. Someone with a perfectionist streak might refuse to take valid trades unless conditions feel 100% ideal. Recognizing these patterns is the first step to breaking them. Jacques, building a trader's mindset for the long term. The markets don't change, you do. Lasting success comes from detachment from outcomes, focusing on process over profits, embracing uncertainty, accepting that no trade is ever guaranteed, continuous self-awareness, regular mental check-ins to prevent autopilot trading. The final edge in trading isn't a secret indicator, it's the ability to outthink your own instincts while others are ruled by them. Master this, and you master the game. Chapter 5. Risk Management and Capital Preservation. The most brilliant trading strategy means nothing without ironclad risk management. This chapter reveals the mathematical frameworks and psychological disciplines that separate surviving traders from those who become statistics. You'll learn how professional trading firms approach risk and how to apply these principles to protect your capital through every market condition. The Risk Management Hierarchy. 1. Portfolio-level risk. Never risk more than 1 to 2% of total capital on any single trade. Maximum 5 to 6% total capital exposure at any given time. Monthly loss limits, typically 8 to 12% of capital. 2. Trade-level risk. Fixed percentage versus volatility-based position sizing. Stop-loss placement techniques. Technical stops, below support, above resistance. Volatility stops ATR multiples. Time stops, exiting stagnant trades. 3. Instrument risk. Correlation analysis between positions. Sector concentration limits. Liquidity considerations. The mathematics of ruin. The Kelly criterion provides the optimal position size F equals open parenthesis, BP minus Q, close parenthesis, divided by B, where F equals fraction of capital to risk. B equals net odds, received, reward-risk ratio. P equals probability of winning. Q equals probability of losing 1 minus EEP. Example, a strategy with 55% win rate and 1 to 1.5 risk. Reward. FE SIRS, 1.5 times 0.55 minus 0.45, divided by 1.5 equals 0.216, 21.6% per trade. Most traders use fractional Kelly, 1/4 or 1/2, to reduce volatility. Volatility, adjusted position sizing. Average true range. ATR sizing formula. Position size equals account risk percent divided by ATR times point value times risk multiple. Example for ES futures, $100,000 account risking 1%. ATR 14 equals 50 points. Point value equals $50. Risk multiple equals 2. Stop at 2 times ATR. 0.01 times $100,000 divided by 50 times $50 times 2 equals 2 contracts. Advanced stop-loss techniques. 1. Dynamic trailing. Stops. chandelier exit, high watermark, ATR multiple, parabolic SAR, volatility bands. 2. Profit protection methods. Time-based partial exits, scale out after X bars. Technical partial exits, at measured moves. Options hedges, protective puts calls. 3. Correlation, hedging. Pair trading, long-short correlated instruments. Minus beta-weighted portfolio hedging, VIX derivatives for equity portfolios. Drawdown recovery mathematics. The formula for recovery percentage, required gain equals 1 divided by 1 minus drawdown, minus 1. Example, 20% drawdown requires 25% gain to recover. 1 divided by 1 minus 0.20. To the power of negative 1 equals 0.25 to the power of 1 equals 25%. Key implications. 50% loss requires 100% gain to recover. Below 30% drawdown keeps recovery feasible. Beyond 50% becomes statistically improbable. Portfolio stress testing. 1. Historical scenario. Analysis. 2008 financial crisis parameters. 2020 COVID crash dynamics. 1987 Black Monday conditions. 2. Monte Carlo simulation. 10,000 random market path generations. Probability distribution of outcomes. Value at risk, VAR calculations. 3. Liquidity crisis modeling. Bid-ask spread expansion. Slippage estimation. Margin requirement increases. The professional risk mindset. 1. Pre-trade rituals. Margin requirement verification. News event cross-check. Correlation matrix review. 2. Intraday monitoring. Real-time risk exposure dashboards. Concentration alerts. Liquidity depth indicators. 3. Post-trade analysis. Win-loss ratio auditing. Slippage tracking. Strategy correlation monitoring. Capital preservation frameworks. 1. The 3-bucket system. Trading capital, actively risked. Reserve capital, opportunity fund. Protected capital, untouchable. 2. Withdrawal rules. Fixed percentage of profits. Quarterly rebalancing, compound then withdraw approach. 3. Black Swan protocols. Market condition filters. Automatic size reducers. Disaster hedging strategies. Risk management in different market regimes. 1. High volatility regimes. Reduced position sizes. Wider stops. Increased hedging. 2. Low volatility regimes. Tighter stops. Higher position turnover. Theta-based strategies. 3. Trending versus range-bound markets. Trend following, let profits run. Mean reversion, take quick profits. The psychological dimensions of risk. 1. Risk perception. Biases. Normalcy bias, underestimating tail risks. Hindsight bias, misremembering risk decisions. Control illusion, overestimating influence. 2. Risk tolerance calibration. Drawdown stress testing. Sleep test, positions you can hold comfortably. Account size-adjusted aggression curves. 3. Risk communication protocols. Trading journal risk notes. Mentor peer risk reviews. Automated risk alerts. Building your risk management system. 1. The risk matrix. Technical risk, chart-based. Quantitative risk, statistical. Fundamental risk, event-based. Liquidity risk, execution-based. 2. The risk dashboard. exposure meters, portfolio heat maps, scenario analyzers. 3. The risk improvement process, monthly risk reviews, strategy risk scoring, continuous protocol refinement. This comprehensive approach transforms risk management from an afterthought to your most powerful trading edge. Implement these frameworks systematically, and you'll achieve what eludes most traders: longevity in the markets. Chapter 6. Technical Analysis. Mastery. The charts whisper their secrets to those who know how to listen. Technical analysis represents the purest form of market psychology made visible, a graphical representation of human fear, greed, and indecision. This chapter will transform you from a casual chart reader into a technical analysis specialist capable of identifying high-probability trading opportunities across any market or time frame. The 3 pillars of price analysis. 1. Price action anatomy. Candlestick forensics, wick analysis, body proportions. Volume at price theory. Auction market principles, balance versus imbalance. Fractal market patterns. 2. Market structure, diagnostics. Trend qualification techniques. Higher highs, higher lows validation. Slope analysis, angle, acceleration. Trend exhaustion signals. Trading range analysis, nested ranges. Time compression patterns. False breakout traps. 3. Liquidity mapping. Identifying stop clusters. Liquidity voids, price gaps. Order flow imbalance zones. Market maker paint techniques. Advanced charting techniques. 1. Composite profile analysis. Volume profile integration. Time price opportunity matrices. Multiple time frame confluence mapping. Session segmentation. Asian London New York ranges. 2. Dynamic support resistance. Fibonacci resonance zones. Volume-weighted pivot points. Option strike price magnets. Algorithmic recognition levels. 3. Pattern probability. Matrix. Classic pattern success rates. Head and shoulders, 73.2% success when confirmed. Flags pennants, 68.5% continuation rate. Double tops, jocks bottoms, 64.3% reversal accuracy. Harmonic pattern precision. Bat pattern, 88.6% accuracy in liquid markets. Crab pattern, 82.3% reversal consistency. Deep 88.6% retracement setups. Institutional grade indicators. 1. Smart money. Tools. Cumulative delta divergence. Volume-weighted MACD. Order flow imbalance indicators. Large lot tracking algorithms. 2. Volatility-adjusted indicators. Adaptive moving averages. Keltner channels with ATR scaling. Dynamic Bollinger Bands. VIX normalized RSI. 3. Machine learning enhanced tools. Neural network pattern recognition. Cluster analysis indicators. Predictive regression channels. Genetic algorithm optimized parameters. Multi-time frame analysis. Framework. 1. The 3-time frame hierarchy. Macro, Forex trading time frame. Trading, operational time frame. Micro, 1 quarter trading time frame. 2. Confluence, scoring system. Technical alignment scoring, 0 to 10. Weighted factor analysis. Probability, adjusted positioning. 3. Time frame synthesis techniques. Higher time frame filtering. Lower time frame precision entries. Time translation patterns. Market cycle technicals. 1. Accumulation phase. Signs. Volume contraction at support. Smart money absorption patterns. Basement breakout traps. 2. Markup phase. Indicators. Expansion breakouts. Momentum confirmation signals. Liquidity grab continuation patterns. 3. Distribution phase. Warnings. Churning volume. Failed new highs. Hidden divergence. 4th. Decline phase triggers. Liquidity crisis patterns. Cascade effect signals. Capitulation volume spikes. Algorithmic technical strategies. 1. HFT pattern recognition. Microsecond chart patterns. Order book imbalance trading. Latency arbitrage setups. 2. Quantitative edge models. Statistical arbitrage signals. Mean reversion algorithms. Volatility clustering strategies. 3. Retail algo hybrid approaches. Detecting algo stop hunts. Front-running institutional flows. Co-location effect trading. Technical analysis psychology. 1. Self-fulfilling prophecies. USPIN. Retail versus institutional pattern recognition. Key levels that matter because they matter. The reflexivity of technical signals. 2. Perception management. Identifying painted charts. Detecting spoofing patterns. Recognizing genuine versus fake breakouts. 3. Confirmation bias traps. Pattern-seeking overreach. Backtest overfitting dangers. The illusion of technical certainty. Building your technical edge. 1. The scanner framework. Custom screening parameters. Real-time alert systems. Historical pattern testing. 2. The technical dashboard. Multi-factor indicator arrays. Market breadth integration. Sentiment overlay tools. 3. Continuous improvement. Pattern journaling. Technical postmortems. Adaptive strategy evolution. This technical mastery framework gives you the tools to read price action like a professional trader. Remember, technical analysis is not about prediction, but about probability assessment and risk management. The charts don't lie, but they require an educated eye to interpret their true message. Chapter 7. Fundamental Analysis for Traders. While technical traders study charts, fundamental analysts speak the language of balance sheets and economic reports. This chapter bridges the gap between corporate financials and price action, transforming dry accounting data into actionable trading edges. You'll learn how hedge funds parse earnings reports, how macroeconomic shifts move markets, and how to trade fundamental catalysts with precision timing. The Fundamental Trader's Toolkit. 1. Financial Statement Forensics. Income Statement. Red flags. Revenue recognition tricks. Expense capitalization games. EBITDA adjustments scrutiny. Balance sheet landmines. Inventory bloat detection. Receivables quality analysis. Debt covenant triggers. Cash flow reality checks. Operating cash versus net income. Capital expenditure quality assessment. Financing cash flow warnings. 2. Ratio analysis that matters. Liquidity traps. Current ratio distortions. Quick ratio reality checks. Profitability mirages. Gross margin compression signs. ROIC versus ROE divergence. Leverage dangers. Debt over EBITDA covenant risks. Interest coverage time bombs. Earnings. Season strategies. 1. The whisper number game. Tracking analyst estimate revisions. Sentiment analysis on earnings calls. Guidance versus expectations analysis. 2. Options. Positioning analysis. Implied move calculations. Gamma exposure positioning. Straddle, strangle breakpoints. 3. Post-earnings drift patterns. Quality of beat analysis. Revenue-led versus cost-cutting beats. Guidance-adjusted reactions. Sector rotation effects. Short squeeze potentials. Economic data trading. 1. The big three indicators. Non-farm. Payrolls. Household versus establishment survey. Participation rate reality check. Wage inflation signals. CPI reports. Core versus headline deception. Shelter cost lag effects. Fed reaction function. GDP releases. Inventory adjustment noise. Real final sales truth. Recession probability signals. 2. Central bank decoding. FOM. C statement linguistics. Dovish/hawkish keyword tracking. Dot plot trajectory analysis. ECB/BOJ/BOE nuances. Currency intervention tells. Yield curve control impacts. Forward guidance traps. Policy pivot false flags. Real versus stated priorities. Geopolitical risk trading. 1. The conflict playbook. Energy market shockwaves. Safe haven flows. Supply chain disruption winners. 2. Trade war strategies. Tariff escalation timelines. Retaliation target analysis. Currency weaponization plays. 3. Sanctions impact analysis. Secondary sanction risks. Commodity flow rerouting. Financial system workarounds. Sector-specific fundamentals. 1. Tech. Sector catalysts. Product cycle analysis. TAM expansion potential. Cloud revenue quality. 2. Energy market drivers. Contango backwardation plays. Storage capacity thresholds. Refining margin analysis. 3. Financial sector dynamics. Net interest margin sensitivity. Loan loss provision games. Trading revenue volatility. Fundamental technical synthesis. 1. The convergence trade. Finding fundamentally sound technical breakouts. Identifying technically oversold quality assets. Earnings gap fill probabilities. 2. Divergence alerts. Deteriorating fundamentals in uptrends. Improving fundamentals in downtrends. Insider trading versus price action mismatches. Building your fundamental process. 1. The research pipeline. Earnings calendar prioritization. Economic data timeline mapping. Geopolitical event monitoring. 2. The decision matrix. Fundamental scorecards. Catalyst impact weighting. Position sizing by conviction. 3. The execution plan. Pre-event positioning rules. News release protocols. Post-event management. This fundamental framework gives traders the ammunition to compete with institutional analysts. Remember, in markets, fundamentals determine the destination while technicals map the journey. Master both, and you'll trade with the confidence of someone who truly understands what moves prices at their core. Chapter 8. Trading System Development. The difference between random trading and professional execution lies in systematic rigor. This chapter provides the complete blueprint for developing mechanical trading systems that remove emotion from decision-making and enforce statistical edges. You'll learn how hedge funds and proprietary trading firms construct robust systems capable of weathering all market conditions. The 7 pillars of trading system. Design. 1. Market Selection Framework. Liquidity Metrics Analysis, ADV, Bid-Ask Spreads. Volatility Suitability Assessment, ATR, HV versus IV. Trading Hour Compatibility, Session Overlaps. Instrument Correlation Screening. Second, Edge Identification Process. Behavioral Inefficiencies to Exploit. Overreaction to News Events. Option Expiration Effects. Quarter-End Window Dressing. Index Rebalancing Flows. Statistical Arbitrage Opportunities. Mean Reversion Tendencies. Momentum Continuation. Volatility Clustering. Seasonal Patterns. 3. Signal Generation Engine. Primary Trigger Mechanisms. Technical Pattern Breakouts. Fundamental Catalyst Alerts. Quantitative Model Outputs. Sentiment Extreme Signals. Filter Layers. Trend Confirmation. Volume Validation. Volatility Adjustment. Correlation Screening. Position Sizing Mathematics. 1. Risk-Adjusted Allocation Models. Fixed Fractional Sizing. Volatility Targeting, percent of ATR. Kelly Criterion Variations. Portfolio Heat Control. 2. Dynamic Scaling Algorithms. Volatility. Adjusted Scaling In. Profit-Based Scaling Out. Correlation-Aware Position Growth. Drawdown Controlled Size Reduction. Entry-Exit Protocol Design. 1. Order Execution Systems. Market Structure Analysis. Liquidity-Seeking Algorithms. Dark Pool Routing Logic. Time Slicing Protocols. Smart Order Types. Hidden Liquidity Detection. Iceberg Order Strategies. Benchmark Price Targeting. 2. Exit Strategy Matrix. Time-Based Exits. Fixed Duration. News Event Expiration. Session Close Rules. Price Target Exits. Fibonacci Extensions. Measured Moves. Option Strike Targets. Conditional Exits. Trailing Volatility Stops. Profit Retracement Triggers. Correlation Breakdowns. Backtesting Methodology. 1. Historical Data Requirements. Tick Data versus OHLC Compromises. Corporate Action Adjustments. Survivorship Bias Avoidance. Liquidity Simulation Modeling. 2. Walk Forward Testing. Out-of-Sample Period Selection. Parameter Stability Analysis. Regime Adaptation Testing. Monte Carlo Validation. 3. Scenario Stress Testing. Flash Crash Simulations. Liquidity Drought Scenarios. Margin Requirement Shocks. Slippage Worst Case Modeling. Performance Metrics Hierarchy. 1. Essential Statistics. OTIs. Win Rate versus Payoff Ratio. Expectancy per trade. Sharpe/Sortino ratios. Maximum Favorable Excursion. 2. Risk Analysis. Drawdown Duration Analysis. Risk of Ruin Calculations. Underwater Curve Analysis. Worst Trade Cluster Detection. 3. Stability Metrics. Strategy Fragility Index. Parameter Sensitivity. Regime Dependence. Cash Flow Volatility. System Automation Pathways. 1. Retail Platform. Coding. Think or Swim Scripting. MetaTrader. EA Development. TradingView Alert Automation. Interactive Brokers. API. 2. Professional Grade Implementation. Python Backtesting Frameworks. Backtrader. Zipline. PyAlgoTrade. Execution Infrastructure. AWS Cloud Hosting. Colocation Considerations. Low Latency Data Feeds. Continuous Optimization Framework. 1. Adaptation Protocols. Parameter decay monitoring, regime detection systems, market microstructure updates, competitor response modeling. Second, version control discipline, change logging requirements, rollback procedures, parallel testing environments, production deployment checks, the trader's system, checklist. 1. Pre-launch verification, strategy documentation completeness, error handling robustness, broker compatibility testing, fail-safe mechanisms. Second, live monitoring systems, real-time performance dashboards, execution quality tracking, market condition alerts, capacity utilization limits. 3. Post-mortem procedures, weekly performance reviews, anomaly, investigation protocols, system health scoring, improvement backlog. This systematic approach transforms discretionary guesses into engineered certainty. Remember, the market constantly evolves, and so must your systems. The most successful traders aren't those with perfect strategies, but those with the most adaptable frameworks for continuous improvement. Chapter 9. The Trader's Lifestyle. The markets never close, but neither should your commitment to mastery. This final chapter reveals the hidden architecture behind sustainable trading success, the daily rituals, mental frameworks, and lifestyle choices that separate enduring professionals from transient gamblers. You'll learn how to structure your environment for peak performance while avoiding the burnout that claims most traders. The Circadian Trading Edge. 1. Biological Primetime Alignment. Morning Analytical Peak, 6 to 9 a.m. Data Review and Scenario Planning. System Diagnostics. Pre-Market Preparation. Midday Consolidation, 12 to 2 p.m. Position Audits. Stress Management. Physical Movement. Afternoon Creativity Window, 3 to 5 p.m. Strategy Development. Journal Reflection. Next Day Planning. 2. Sleep Optimization Protocol. Melatonin Management for Shift Workers. Sleep Cycle Alignment with Market Hours. Power Nap Strategies for 24-hour traders. Blue Light Exposure Control. Nutritional Alpha Generation. 1. Cognitive Enhancement Foods. Omega-3 Rich Diets for Neural Efficiency. Nootropic Supplementation Protocols. Blood Sugar Stabilization Techniques. Hydration Monitoring Systems. Second, Trading Session. Fueling. Pre-market breakfast matrices. Desk-side performance snacks. Caffeine titration strategies. Recovery nutrition post-close. Physical resilience systems. 1. Trader's exercise prescription. Postural correction routines. High-intensity interval training benefits. Isometric desk exercises. Eye strain prevention regimens. 2. Ergonomic battle station. Monitor configuration science. Chair selection criteria. Keyboard/mouse optimization. Blue light filtration systems. Mental performance architecture. 1. Cognitive load management. Decision fatigue countermeasures. Information filtration systems. Attention restoration practices. Digital minimalism protocols. 2. Emotional regulation. Toolkit. Biofeedback training. Breathing pattern mastery. Anchoring techniques. Pressure inoculation. Environmental design for trading. Success. 1. Sensory optimization. Lighting temperature controls. Soundscape engineering. Olfactory performance triggers. Tactile feedback systems. 2. Workspace psychology. Status elevation positioning. Visual cue programming. Clutter management. Inspiration placement. The trader's social ecosystem. 1. Network topology. Mentor relationships, mastermind groups, information filters, reality check contacts. 2. Relationship management, family education protocols, social isolation prevention, boundary setting techniques, success celebration rituals, performance tracking systems. 1. Daily debrief framework. Trade execution scoring, process adherence grading, emotional state logging, improvement commitments. 2. Quarterly reinvention cycles, skill audit procedures, technology upgrades, strategy evolution, lifestyle reassessment. The longevity protocol. 1. Burnout prevention. Forced downtime scheduling, diversification of interests, identity separation techniques, energy renewal practices. 2. Wealth preservation psychology, lifestyle inflation controls, stewardship mindset, generational planning, philanthropic allocation. The complete trader's day. 5:30. Wake, circadian light exposure. 5:45. Movement, mobility routine. 0600. Analysis, pre-market preparation. 7 a.m. Fuel, performance breakfast. 7:30. Trading, morning session focus. 10 o'clock. Reset, biofeedback session. 10:15. Trading, midday adjustments. 12:00. Recharge, lunch plus walk. 1300. Trading, afternoon flow. 1500. Create, strategy development. 1600. Recover, exercise plus shower. 1700. Reflect, journal review. 1800. Live, personal time. 2100. Prepare, next day setup. 21:30. Rest, digital sunset. 2200. Sleep, recovery optimization. The trader's legacy. True trading mastery isn't measured in quarterly returns, but in decades of consistent performance. By internalizing these lifestyle principles, you're not just building a career. You're crafting a sustainable advantage that compounds over time. The market will test your discipline daily, but those who respect the game's mental and physical demands will find it rewards them beyond mere financial gains. This concludes the Ultimate Trading and Investing Bible. You now possess the complete framework, from technical skills to psychological mastery to lifestyle design, to thrive in any market condition. The path forward is yours to walk. Trade wisely,